You can count on us like 1, 2, 3, we'll be there. And we know what you need and we are count on me. We will help you with accounting. Let's learn together to achieve our dreams.
Hi everyone! Welcome to Account on Me Season 2. I am Maxynn Racuya and I will be your study partner for this video. So get ready and let's start accounting. In this video, I will tackle Chapter 8, which is about Note Payable. Under this chapter, we will define a promissory note, know the initial measurement of note payable, understand the subsequent measurement of note payable and amortized cost, understand the fair value option of measuring note payable, and know the accounting for note payable issued solely for cash and interest-bearing and non-interest-bearing note payable issued for property. Since you already have an idea of what we are going to discuss today, I hope you are now ready. So, let's start our discussion by defining note payable. Note payable is a liability account in which a borrower's written promise to pay a lender is recorded. This written promise is also called as promissory note. As its name implies, it is an unconditional promise in writing made by one person to another, signed by the maker, engaging to pay on demand or at a fixed or determinable future time a sum certain in money to order or to bearer. So, for a document to be considered as a promissory note, it must contain the signature of the one who made it, a fixed or determinable date or time, and the certain amount of money the maker will pay in the said date. Here's an example of a promissory note. As you can see, this contains the name of the promisor, the amount, the date, and of course the signature, pero tinakpan ko lang dito. Not every promissory note looks like this. What's important is that it includes the necessary details we have mentioned a while ago. Let's now move on to the initial measurement of note payable. Under PFRS 9, Paragraph 5.1.1, a note payable not designated at fair value through profit or loss shall be measured initially at fair value minus transaction costs that are directly attributable to the issue of note payable. This indicates that transaction costs are included in the measurement of note payable. However, the transaction costs are expensed immediately if the note payable is irrevocably designated at fair value through profit or loss. The fair value of the note payable is equal to the present value of the future cash payment to settle the note payable using market rate of interest. After initial recognition, as stated in PFRS 9, paragraph 5.3.1, a note payable shall be measured A. at amortized cost using the effective interest method, and B. if the note payable is designated irrevocably at fair value through profit or loss, then it is measured at fair value through profit or loss. Let's proceed to amortized cost of note payable. The amortized cost of note payable is the amount at which the note payable is measured initially minus principal repayment or plus or minus the cumulative amortization using the effective interest method of any difference between the face amount and present value is either the discount or premium on the issue of note payable. Actually, the difference between the face amount and present value is either discount or premium on the issue of note payable. Now, we are going to tackle note issued solely for cash. When a note payable is issued solely for cash, the present value is equal to the cash proceeds. For us to understand this better, let's try answering this illustration. On November 1, 2021, an entity discounted its own note of 1 million pesos at 12% for 1 year. As I have said, the present value is equal to the cash proceeds, which is the difference between note payable and the discount on note payable. So, for this problem, we will deduct 120,000 pesos, which is the discount on note payable, to 1 million pesos, and the difference will be 880,000 pesos, which is now the net proceeds. Additionally, to get the discount on note payable, we just have to multiply 12% discount to the amount of note payable, which is 1 million. Now that we have the present value, let us prepare the journal entry. First, we will debit cash for 880,000 pesos, which is at present value. We will also debit the discount on note payable amounting to 120,000 pesos. Lastly, we will credit note payable for 1 million pesos. Actually, the discount on note payable of 120,000 pesos is the total interest expense for 1 year. Thus, on December 31, 2021, after 2 months, the discount on note payable is amortized as interest expense. So, to record the journal entry for this, we will debit interest expense for 20,000 pesos and credit discount on note payable for 20,000 pesos as well. How did we get 20,000 pesos? We allocated the discount on a pro rata basis. To compute, we will just multiply 120,000 pesos to 2 over 12, which is 2 over 12 months, and we will get 20,000 pesos. In amortizing the discount on note payable, straight line method is used for simplicity. Besides, the note payable has only a term of 1 year. If a statement of financial position is prepared on December 31, 2021, the note payable is classified and reported as current liability. To compute for this, we will deduct the 100,000 pesos discount to the note payable, which is 1 million pesos. Its difference is 900,000 pesos, and it is the carrying amount. Also, the carrying amount of 900,000 pesos is actually the amortized cost of the note payable. Here, you'll observe that the discount on note payable is a direct deduction from the face amount of the note payable. You may pause this video if you need more time to understand this, but if you're still good, then let's proceed to interest-bearing note issued for property. When a property or non-cash asset is acquired by issuing a promissory note which is interest-bearing, the property or asset is recorded at the purchase price. The purchase price is assumed to be the present value of the note and therefore the fair value of the property because the note issued is interest-bearing. In order to better understand this, let us check this illustration. On January 1, 2021, an entity acquired an equipment for 1 million pesos payable in 5 annual equal installments every December 31 of each year. Interest is 10% on the unpaid balance. The journal entries for 2021 are as follows. First, on January 1, to record the acquisition of equipment, we will debit equipment for 1 million pesos, which is the purchase price. And since the entity acquired the equipment to note, we will credit note payable for 1 million pesos as well. Next, on December 31, to record the payment of the first installment and the interest for the year, we will debit interest expense for 100,000. We got 100,000 by multiplying 10% interest to the purchase price of the equipment, which is 1 million pesos. Next, we will also debit note payable for 200,000 pesos. Why 200,000? Because, as mentioned in the problem, the equipment is payable in 5 annual equal installments. So, 1 million divided by 5 is equal to 200,000. Lastly, we will credit cash for 300,000. To record the payment for second installment and interest for the year 2022, we will debit interest expense for 80,000 pesos. To get this amount, we will multiply 10% to 800,000 pesos. 800,000 na lang since nabawasan na yung purchase price kasi nabayaran na natin yung unang 200,000 or installment last year. Next, we will debit again note payable for 200,000 pesos and then credit cash for 280,000 pesos. I hope you are still fine with our discussion. If yes, let's move forward to non-interest bearing note issued for property. When a non-interest bearing note is issued for property, the property is recorded at the cash price of the property. The cash price is assumed to be the present value of the note issued. The difference between the cash price and face amount of the note payable represents the imputed interest. The imputed interest is based on the sound philosophy that no lender would part away with his money or property interest-free. Let's try an example again for this topic. On January 1, 2021, an entity acquired an equipment with a cash price of 350,000 pesos for 500,000 pesos and 100,000 pesos down and the balance payable in 4 equal annual installments. For this illustration, the journal entries for 2021 are the following. For January 1, we will debit equipment for 350,000 pesos which is its cash price. Then, we will also debit discount on note payable for 150,000 pesos which is the difference between 500,000 pesos and the cash price of 350,000 pesos. Next, we will credit cash for 100,000 pesos which is the down payment, and we will also credit note payable for 400,000 pesos which is the balance payable. For December 31, first, to record payment of annual installment, we will debit note payable for 100,000 pesos and then credit cash for 100,000 pesos as well. Why 100,000 pesos? Because the balance of note payable is 400,000 pesos and it was mentioned in the problem that this balance must be paid in 4 equal annual installments. Next, to record amortization for the discount for 2021, we will debit interest expense for 60,000 pesos and credit discount on note payable for 60,000 pesos as well. Let's look at this table of amortization so that we can easily understand how we get the amount recorded earlier. First, the column for note payable represents the amount outstanding every year. The note was issued on January 1, 2021, and the first payment was made on December 31, 2021. Thus, for 2021, the note payable outstanding is 400,000 pesos. On the next column, it is the fraction which is equal to the note payable outstanding each year over the total amount of outstanding note payable. Lastly, the column for amortization is the amount of discount multiplied by the fraction developed. For example, for 2021, 150,000 pesos discount times the fraction 4 over 10 is equal to 60,000 pesos. In case there is no cash price, let's try this illustration. On January 1, 2021, an entity acquired an equipment for 1 million pesos payable in 5 equal annual installments on every December 31 of each year. Observe that there is no agreed interest and no cash price is available for the equipment. In such case, the cost of the equipment is equal to the present value of the 200,000 pesos annual installments in 5 years at an appropriate rate of 10%. The rate of 10% is assumed to be the prevailing market rate of interest. The present value of an ordinary annuity for 5 years at 10% is 3.7908. The present value of 200,000 pesos installments is computed by multiplying 200,000 pesos by the present value factor of 3.7908 equals to 758,160 pesos. Let us now record the journal entries for 2021. For January 1, to record the acquisition of equipment, first, we will debit equipment for 758,160 pesos, which is the present value of 200,000 pesos installments. Next, we will debit discount on note payable as well for 241,840 pesos, which is the difference of the cost and present value of equipment. Lastly, we will credit note payable for 1 million pesos. Next, for December 31, to record the first installment payment, we will debit note payable for 200,000 pesos and credit cash for 200,000 pesos. The amount to be recorded is 200,000 pesos because the equipment is payable in 5 equal annual installments. The last entry for 2021 is to record the amortization of the discount on note payable. So first, we will debit interest expense for 75,816 pesos and then credit discount on note payable for the same amount. In here, we followed the effective interest method. To find out how the amortization amount was obtained, let us look at the table of amortization. On the column of payment, at the end of every year, the entity will pay equal installments amounting to 200,000 pesos. The next column represents the interest, which is equal to the preceding present value multiplied by the implied interest, which is 10%. So, for example, for the year 2021, the interest is computed by multiplying the preceding present value of 758,160 pesos by the 10% implied interest rate. So, the interest for 2021 is 75,816 pesos. Let's now move to the fourth column, which is the principal. The principal is the portion of the payment after deducting interest representing principal. Hence, for December 31, 2021, the principal is 124,184 pesos, which is the difference of the 200,000 pesos annual installment or payment and interest of 75,816 pesos. Lastly, the column for present value is the balance of the preceding present value after deducting the principal payment. So, on December 31, 2021, the present value of 758,160 pesos minus the principal payment of 124,184 pesos is equals to 633,976 pesos. Next, on December 31, 2021, the current portion of the note payable should be reported as current liability. To compute for this, the annual installment of 200,000 pesos minus the discount on note payable of 63,398 pesos equals to the carrying amount at amortized cost of 136,602 pesos. You'll notice that this is the principal for December 31, 2022. On the contrary, the non-current portion of the note payable should be reported as non-current liability. When we say non-current liability, it is an obligation not due for settlement within 1 year. So, ang ire-record natin ay yung year 2023, 2024, and 2025. Thus, the total of note payable outstanding is 600,000 pesos minus the discount on note payable of 102,626 pesos, which is the sum of interest for 2023 to 2025. So, the carrying amount at amortized cost is equal to 497,374 pesos. Let us now tackle the non-interest bearing note payable lump sum. So, here's an illustration. On January 1, 2021, an entity acquired an equipment for 1 million pesos. The entity paid 100 pesos down and signed a non-interest bearing note payable for the balance, which is due after 3 years on January 1, 2024. There was no established cash price for the equipment. In addition, the prevailing interest rate for this type of note is 10%. The present value of 143 periods is 0.7513. What we are going to do first is to get the cost of equipment. So, the down payment of 100,000 pesos plus the present value of note payable of 676,170 pesos is equal to 776,170 pesos. The present value of note payable is computed by multiplying the note payable balance of 900,000 pesos by 0.7513, which is the present value of 143 periods. Next, we are going to compute for the imputed interest by deducting the present value of note payable of 676,170 pesos to the face amount of note payable of 900,000 pesos. So, the imputed interest is equal to 223,830 pesos. Let us now record the journal entries. First, to record the purchase of equipment on January 1, 2021, we will debit equipment for 776,170 pesos, which is the cost we computed earlier. Next, we will debit discount on note payable as well for 223,830 pesos, which is the imputed interest we got earlier. Next, we will credit cash for 100,000 pesos, which is the down payment. And lastly, we will also credit note payable for 900,000 pesos, which is its face amount. Our second journal entry is to record the interest expense for 2021. We will debit interest expense for 67,617 pesos, which is computed by multiplying the 10% prevailing interest rate to the present value of note payable of 676,170 pesos. Then, we will credit discount on note payable for 67 and 617 pesos as well. Our last journal entry for this problem is to record the full payment of the note on January 1, 2024. We will debit note payable for 900,000 pesos and then credit cash for the same amount. Please take note that we are talking about lump sum, which means that an amount is paid all at once. That is why we recorded the full payment at January 1, 2024. Just like what we did with the previous illustrations, here's a table of amortization. Again, the first column is for the date. Next, for the column of interest expense, it is the same as what we did in the previous illustration. So, for 2021, the interest expense is computed by multiplying the preceding present value of 676 and 170 pesos by the 10% implied interest rate. So, the interest expense for 2021 is 67,617 pesos. Next, the column for discount on note payable represents the balance minus the interest expense every year. Thus, on December 31, 2021, The discount on note payable balance from January 1, 2021, which is 223,830 pesos, minus the interest of 67,617 pesos equals 156,213 pesos. Lastly, the column for present value is the preceding balance plus the interest expense every year. Therefore, on December 31, 2021, the preceding balance of 676,170 pesos plus the interest of 67,617 pesos is equal to 743,787 pesos. We are now on to our last topic for Chapter 8, which is about fair value option of measuring note payable. PFRS 9 paragraph 4.2.2 provides that at initial recognition, a note payable may be irrevocably designated as at fair value through profit or loss. PFRS 9 paragraph 5.7.7 provides that the gain or loss on financial liability designated at fair value through profit or loss shall be accounted for as follows. A. The change in fair value attributable to the credit risk is recognized in other comprehensive income. Here, the credit risk pertains to the risk that the issuer of the liability would cause a financial loss to the other party by failing to discharge the obligation. It does not include market risk such as interest risk, currency risk, and price risk. Letter B. The remaining amount of the change in fair value is recognized in profit or loss. Application Guidance B 5.7.9 provides that amount recognized in other comprehensive income resulting from change in fair value attributable to credit risk shall not be subsequently transferred to profit or loss. However, the cumulative gain or loss recognized may be transferred within equity or retained earnings. Under the fair value option, any transaction cost is recognized as outright expense. Also, take note that there is no amortization of discount and premium on note payable. Moreover, the interest expense is recognized using the nominal or stated interest rate. For illustration, let us try this one. So please read the problem and you may pause this video and then resume once you are ready. Okay, I hope you have read and understood the problem. Let us now start recording the journal entries for 2021. First, on January 1, to record the borrowing on an interest-bearing note, we will debit cash for 4 million pesos, which is the fair value of the note, and then credit note payable for the same amount. Our next journal entry, we will record the transaction cost paid by the entity by debiting transaction cost for 100,000 pesos and crediting cash for 100,000 pesos as well. On December 31, we will record the interest by debiting interest expense of 480,000 pesos. To compute for the interest expense, we will just multiply the 12% interest rate by the fair value of the note of 4 million pesos. And then, we will credit cash for 480,000 pesos as well. Lastly, kung maalala nyo, na-mention sa problem that the entity has elected irrevocably the fair value option for measuring the note payable. So, to record this, we will debit note payable for 500,000 pesos, which is the gain from change in fair value. Next, we will credit the gain from change in fair value for 450,000 pesos and the gain from credit risk recognized in other comprehensive income for 50,000 pesos. To explain this further, Here's the computation for the decrease in fair value of liability. The carrying amount of note payable of 4 million pesos minus the fair value of the note payable on December 31, 2021 amounting to 3,500,000 pesos. So, the gain from the change in fair value is 500,000 pesos. To reiterate, the gain from change in fair value is recognized in profit or loss. On the other hand, the gain from credit risk is recognized in other comprehensive income. That concludes my discussion for Chapter 8, and I hope you have learned something new from this video. Thank you so much for watching and listening. Additionally, we want to thank you for watching the videos of Account on Me Season 2. We hope that our assistance with your studies was helpful. Once again, thank you and God bless us all.
Let's learn together to achieve our dreams.